I'm Cynthia Rowland, and this is episode 71 of EO Radio Show. This week, I'm delighted to have as my guest Stephanie Hood, my colleague here at Farella Braun Martel, and a member of our top-notch estate planning practice and key member of our private client industry group. Our clients often come to us with a request to help them think about funding charities during their lifetimes, as well as through their estate plan. In addition to thinking about how to best structure the gifts to make sure that their charitable intent is carried out, many of these clients are also sensitive to the federal and state tax consequences of their gifts. Stephanie is here today to talk through the complex rules and some traps for the unwary. Welcome to the EO Radio Show, your nonprofit legal resource. Brought to you by the Exempt Organizations Group at Farella Braun Martel. My name is Cynthia Rowland, and I'm a partner at Farella. I'm a business and tax lawyer with more than 30 years of experience advising clients on nonprofit and charity law. Through this podcast, our lawyers and guests will discuss a range of legal and business issues impacting the nonprofit world because we understand you work hard every day to make your community a better place to live and do business. Many of our programs focus on the basics, and at times we'll do a deep dive into narrow and complicated legal issues. Again, welcome to the EO Radio Show. We're glad you're here. I'm so happy today to be joined by Stephanie Hood. Stephanie works with individuals and families in our private client industry group here at Farella. She advises clients on a variety of domestic and international trust, estate, and tax matters. Stephanie helps individuals and families with the design, preparation, and implementation of their estate plans. She's experienced in tax planning techniques and valuation discount strategies that minimize the income, gift, and estate tax consequences of multi-generational wealth transfers. She's often also called upon to help clients meet their philanthropic objectives while maximizing tax opportunities. In addition to lifetime planning, Stephanie also helps families and fiduciaries through the post-mortem planning and trust and estate administration process. Recognizing that each client and family situation is unique, she provides solutions for difficult funding, distribution, and transfer issues. Prior to law school, Stephanie worked as a CPA, and she is admitted now to the bar in California, New York, and Florida. Thanks so much for joining me again, Stephanie.
Thank you, Cynthia. I'm happy to be here.
So before we get into some of the tax planning techniques, I want to remind the listeners of some of the basic different types of charitable entities to which U.S. donors can make tax-deductible contributions. We'll be talking about a lot of these things, so I thought I'd just level the playing field and describe some of these basic types. Charities are classified under two basic regimes in the United States, public charities and private foundations. Within those categories, there are some variations that have additional special rules. As for public charities, there are special rules that apply to public charities that operate donor-advised funds, or also known as DAFs, and to public charities that are classified as supporting organizations. Private foundations, on the other hand, are a subset of charitable organization that are subject to additional rules if classified as private operating foundations. The details about these types of charitable organizations are covered in several other episodes, so check out the show notes for links to those episodes and for more information. Second reminder, in addition to thinking about the types of donees, the types of charities to which a donor make a charitable contribution, U.S. taxpayers also need to think about three different types of charitable contribution deductions. The charitable contribution deduction for federal income tax purposes, for federal gift tax purposes, and for estate tax purposes. These rules are not identical, so in some cases it's important to double-check which rules apply. In the states that levy income or estate taxes, those local state rules will also be relevant. The state tax law implications are beyond what we are going to talk about today, but make a note to self to check into that if your state has a gift or estate tax regime. Also, donors who are subject to tax in foreign countries as well as the U.S. will have more issues to think about. And donors who want to make charitable donations to foreign charities, that is, those that are not incorporated in the United States, also need to look at special issues there. But for today, we are just going to focus on U.S. taxpayers who are planning to make charitable contributions to domestic U.S. charities. Let's start with the basic federal charitable income tax rules that donors need to be aware of. So, Stephanie, let's talk about natural persons and the charitable contribution deduction rules that apply to them.
Thanks, Cynthia. Yes. So starting with individuals, which is what all of us think of ourselves as, individuals may deduct up to 60% of adjusted gross income, sometimes referred to as AGI, for charitable cash contributions. It's worth noting that that percentage will decrease to 50% after 2025. For gifts of appreciated property, such as securities with a built-in capital gain, the deduction is limited to 30% of adjusted gross income. And in order for a deduction to qualify as a charitable contribution, it must meet the requirements set out in Internal Revenue Code 170C as an organization that operates for charitable, religious, scientific, literary, or educational purposes, or to prevent the cruelty to children or animals, and is commonly regarded as a qualified organization according to the IRS. So all of the sort of entities you're thinking of that, the Red Cross, the Humane Society, these sort of entities are all qualifying charitable organizations for purposes of getting a charitable contribution deduction on your individual income tax return.
I was just going to chime in there real quick. There's a publication, it used to be in paper, called Publication 78. It's now a website that the IRS monitors or updates nearly daily that lists all of the organizations that are recognized under 170C. So that's another point for confirming that the intended donee is actually a charitable organization.
That's a great point, Cynthia. And another thing I think people often might not think about is in order to qualify for a charitable deduction for your individual income tax purposes, a person must itemize their deductions on their 1040 or their individual income tax return. So for our CPA tax preparers, this is Schedule A. For the rest of us who kind of just rely on TurboTax or the likes to prepare our income taxes every year, you probably itemize your income tax deductions if you're otherwise taking a mortgage interest deduction or you live in a state with a state income tax, though that's largely been capped by the SALT $10,000. But if you don't itemize your income tax deductions, then you won't get the benefit of the charitable contribution.
Yeah, that's a good point.
And I think the final point here to think about, sometimes people find themselves, for one reason or another, making a large charitable contribution in a given year, and then having concern that that charitable contribution is going to be more than what they would be able to take on their income tax for return for purposes of a deduction. You can carry any excess charitable income tax deduction forward 5 years. So that's worth noting. And that, again, that pertains to individuals. There are different rules for other types of entities.
Yeah, that's a really good point. And before we leave the basics of individual charitable deductions, there's also the contemporaneous written acknowledgement requirement that the taxpayer has to receive from the charity before they file the return. But there's a lot of nuts and bolts to all of that. We'll note some of that in the show notes as well. So moving on from individuals, that's the basics for an individual who makes a contribution. Sometimes business corporations make contributions. Anything notable there, Stephanie?
Yeah, the one thing to think in the context of corporations is they may deduct up to 10% of its taxable income each year. So just to keep that in mind, it is a much lower threshold. That said, sometimes corporations have much larger incomes than an individual. But it is something to take in consideration. You are going to be capped at that 10% of taxable income number.
Right. And one other thing I should have thought about earlier, but members of partnerships and shareholders in S corporations, they deduct the entity level tax at their own under the individual limitation rules. So if you're thinking about charitable planning out of a partnership or an S corporation, there's detailed rules that apply there that are more akin to the individual rules than the corporation rules. But you can see the main point of this part of our conversation is that who the donor is really matters in terms of what the contribution and the income tax charitable contribution deduction amounts to.
Absolutely. That's a good point, Cynthia.
Stephanie, any other thoughts on timing and other rules for contributions of cash and appreciated property?
Sure. I think a couple items to think about. Contributions must actually be paid in cash or other property before the close of the tax year to be deductible. And that is regardless of whether you're considered a cash basis or an accrual basis taxpayer. The other rule is you must have a qualified appraisal for gifts of appreciated property, and that should be dated no earlier than 60 days prior to the contribution. So 60 days prior to the contribution date. That's not 60 days from end of year. So if you donate in March, that's going to be 60 days before that March date that you need an appraisal for that contribution. And if you are planning on taking a larger charitable contribution, it is very, very important to retain that paperwork for the audit period if the IRS was going to audit. As you can imagine, this is an area that tends to be heavily audited and something that they do really look at, and they very much examine what you have to substantiate that deduction.
And that appraisal, the way I see that sometimes get glitchy is if a donor's planning a contribution of appreciated property, they go out and have the appraiser do all the work. And then for whatever reason, it takes a while to close the contribution. And now your appraisal is stale. And then you have to get another one. Because if it's an old appraisal, it's not going to do you any good.
Absolutely. That 60-day period is very strictly enforced and something you really need to keep your eye on the ball if you're going to be donating appreciated property.
Yeah. And it's often not a big deal to ask the appraiser to update it, but it's just a little more expensive. So wait for that final qualified appraisal date until you're sure of when your contribution closing will be. So now let's move into the area that I find the most tricky, and that's deciding when and how to make a charitable contribution from assets that are titled in the name of a trust. And this is where Stephanie really focuses on the intricate rules. Many people are aware of revocable trusts, but not so sure about what the distinction is with irrevocable trusts and how all this plays into estate planning, charitable gift planning, and other wealth planning transfers. So, Stephanie, I'll turn it over to you now to talk a little bit about the distinction between these kinds of trusts and what issues we think about when making a charitable contribution from assets that are titled in the name of one or the other.
Thank you. Yes. First, let's just go through the general concept. So when we're talking about a revocable or revocable trust, what we're thinking of most commonly people think of is what a will does, a last will and testament. This is the trust that you set up in order to avoid probate at your passing. It is an entity, but it's very much transparent. I mean, it very much just looks through to yourself. It doesn't require the separate filing of an income tax return. It is not protected by creditors. So really, for purposes of the revocable trust, what we're talking about is the last will and testament substitute. So that's what we mean when we say revocable trust. When we say irrevocable trust, what we're talking about is a trust that cannot be changed. It's in existence. It is generally protected from creditors. It likely has its own income tax filing obligations, though there can be some complexities with grantor versus non-grantor. But what you're talking about with an irrevocable trust is a trust that cannot be changed. It's a trust that was likely the recipient of a gift or a sold transaction. It is not a substitute for a last will and testament. So for purposes of charitable deductions, what we're talking about right now is an irrevocable trust, because a revocable trust is very much the same as everything that would have applied when we spoke about the individual contributions. So that sort of sets the stage for us going forward. For purposes of an irrevocable trust, Internal Revenue Code Section 642C provides that a trust is entitled to an unlimited income tax charitable deduction for charitable contributions to a public charity up to the amount of the trust gross income in the tax year the contribution is made by such trust. A couple things to note here. When we were in the individual realm, we were talking about caps at a percentage of adjusted gross income, or AGI. Now what we're talking about is you can take all of the deduction up to the trust gross income. But this does not mean an endless deduction, because really what constitute gross income for purposes of a trust, it's a set determined amount. You look to the Uniform Trust Code in the applicable state and you say what constitutes income, interest, dividends, etc. Sometimes capital gains, depending on whether the trustee has made a habit of allocating capital gains to income. So what you're dealing with in the trust context is you really have to have a good understanding of what's the trust income, and then you can take the charitable deduction up to the full amount of the gross income in the year, in that given year.
Yeah, so this is really tricky, and it's a trap for the unwary because the words don't mean the same thing. AGI, adjusted gross income for an individual or a gift that they're making from assets in their revocable trust is one thing. That's what we talked about. First off, charitable contribution deductions from an irrevocable trust, that gross income is measured and thought about under a completely different set of rules, if I'm understanding this right. Okay, so Stephanie, that's a great recap of how to distinguish gross income in an irrevocable trust context. I know there's also a trap for the unwary when a trust contributes appreciated property. Can you talk a little bit about what the trap is there and what donors and their advisors need to think about?
Sure. So one of the things that I think oftentimes is a gotcha in the context of trust and charitable income tax deductions, it's in the case where the trust contributes property which became an asset of the trust as part of the funding of the trust. So in this context, what we're saying is you became a beneficiary of an irrevocable trust And when you became a beneficiary, that trust was funded with a low basis asset, or a gift to a trust was made of which you're a beneficiary. So in other words, a grantor, somebody contributed this property to the trust, and this property has a large built-in capital gain.
Like maybe appreciated real estate or appreciated founder stock or something that's very valuable at the time of the contribution, but had a low basis to that funder.
Exactly. Assume the assets appreciated over time. The problem here is there's no charitable income tax deduction. One's not allowed. And the reason is, by definition, the asset is considered corpus, or the principal of the trust. In other words, the asset was contributed to the trust by a donor. The asset over time has appreciated, but the problem is you're never going to meet that gross income test for purposes of being entitled to the charitable income tax deduction on that asset, because by definition, that asset is considered corpus, or the principal of the trust.
So it never generates gross income.
That's exactly right. That's exactly right.
So that's not a good asset to make a charitable gift from an irrevocable trust if you're looking to zero out otherwise taxable income in that irrevocable charitable trust. Did I say that right?
That's right. It's a trap. People don't often see that or understand that. If you have a situation where the asset has come to be the principal of the trust or the corpus of the trust because it was contributed to the trust rather than acquired by the trust directly, you really should consult with your tax advisors on whether or not that's going to give.
So any other traps or notes on charitable gifting from an irrevocable trust?
2 more points on it. While an individual can carry an income tax deduction for a charitable contribution up to 5 years, a trust cannot carry forward that charitable income tax deduction. That said, sometimes a trust may elect to deduct a charitable contribution made in the current year and treat them as though that contribution was made in the prior year. So there is a little bit of relief there. If the timing is just a little bit off, you can deduct the charitable contribution and treat it as if it was made in the prior year. But if you're already over in that year, meaning what you contributed is greater than the trust's gross income, you lose the balance of that deduction because there is no carry forward available in the trust context.
A couple of other kinds of trusts that listeners might come across, I don't want to go into them in depth, but can you explain the difference between a charitable lead trust and a charitable remainder trust?
Sure. So what we're talking about here, charitable lead trust, CLAT, CLT, CLUT, charitable lead annuity trust, charitable lead unit trust. What these charitable lead trusts are is basically a charitable trust. It's a split interest trust. It's specifically spoken to in the Internal Revenue Code as a vessel by which you can take both a gift and an income tax charitable deduction. And basically, there are highly nuanced, complex rules around it. But basically what it is a trust structure whereby you, during your lifetime, or you could do it at death, put in an asset into this trust structure. During the term, the lead payment, the annuity payment, which is made every year, goes to the charity, and then the balance at the end goes back to you or somebody else as the donor. So that's the charitable lead trust. It's sort of considered there's a lead period for a period of time, and then the balance at the end, the lead is going to the charity, and the balance at the end is going back to the donor or someone else.
Right. And I sometimes see those used when a donor wants to make, or a charitably inclined philanthropist wants to make more charitable gifts during their lifetime, but they have also made promises to certain beneficiaries, or they want to benefit private individuals at their death. So it can be a really useful tool to get more out to charity, but still allow for that untaxed, the growth of the assets inside the trust is not subject to taxes, and you can invest it and potentially leave more to the remainder individual beneficiaries. So contrast that with a charitable remainder trust.
So a charitable remainder trust is sort of like the inverse of that. It's when the lead payment is going to the donor or beneficiaries and the remainder portion is going to the charity. So that's where let's say you have a 10-year term, and during that 10-year term, there's an annuity or a unit trust amount that's being kicked off to the individual beneficiary. And then at the end of the 10 years, what's left in the trust, and think this trust has presumably grown in value over the term of the 10 years, that balance is then going to the remainder, which is a charitable beneficiary. These rules are complicated. You have to follow, they're very precisely laid out in the Internal Revenue Code, and you just have to play within the architecture they've afforded you. There's different percentage limitations and minimum amounts that must go to charity and term periods, but there's a lot of planning opportunity, and it's a way to, I oftentimes see clients put appreciated assets into these, and rather than have to take an entire deduction in 1 year, it gives you the ability to sort of bleed it out over multiple years.
Yeah. And not to completely confuse our listeners, charitable remainder trusts and charitable lead trusts are also irrevocable, but they're not the sort of irrevocable trust rules that we were just talking about in the irrevocable trust that's not a split interest trust between charity and taxable individuals. Anyway, my hope is that the listeners are following along and not just having their eyes glazed over.
That's right. It's a type of irrevocable trust, but considered a split interest trust. Anytime you're talking about a term that's set, whether that the term go to the beneficiary or the charitable beneficiary versus an individual beneficiary, that's what's the split interest irrevocable trust.
Yeah. Okay. So let's move on to a couple of other topics that hopefully are not quite as confusing. And that's donor advised funds and private foundations, and some special considerations from philanthropic donors and individuals that want to make gifts either from their individually through a partnership, from a corporation to a donor advised fund or a private foundation. So Stephanie, can you talk a little bit about the characteristics of a donor advised fund, what it is, and which charitable contribution rules apply to that?
Absolutely. So a donor advised fund, or sometimes referred to as a DAF, generally it is a separately identified fund or account that is maintained and operated by a Section 501c3 organization, which is called a sponsoring organization. Each account is composed of contributions made by an individual donor. Once the donor makes the contribution, the organization has legal control over it. However, the donor or the donor's representative retains advisory privileges with respect to the distribution of funds and the investment of the assets in the account. As a donor, you're sort of sending assets over to a sponsoring organization, and that sponsoring organization is then making charitable gifts with the funds that are earmarked there. Oftentimes, the donor advised fund is considered more flexible than a private foundation, but there are many of the same rules and there are complex limitations. Recently issued proposed regulations may have significant impact on the ability to use donor advised funds, and they are subject to significant additional scrutiny. But by and large, donor advised funds, you can gifts as an individual to a donor advised fund, you can deduct up to 60% of your adjusted gross income for cash contributions and 30% of your adjusted gross income for appreciated securities. Similarly, with the 5-year carry forward for individuals, so a contribution to a DAF as an individual, you are going to get that 5-year carry forward, but there are some limitations as opposed to that are similar to the private foundation.
And DAFs are very, very popular because they're a lot like private foundations in the donor's ability to give now and decide later who actually gets it. It gets the donor has the same beneficial charitable contribution rules, like you just mentioned, the 60% of AGI for cash and appreciated securities, which are much more limited for gifts to private foundations, which is the other very common tool for philanthropists that want to have their own private foundation for whatever reason. So you want to talk a little bit about the special deduction rules for contributions to a private foundation, and then we can wrap up by doing a little compare and contrast of the three, the public charity, the DAF, and the private foundation.
So for the private foundation, your charitable deductions for contributions are limited to 30% of adjusted gross income for cash contributions and 20% of adjusted gross income for long-term publicly traded securities. These are lower limitations than you have in the DAF context. However, one benefit that people find with private foundations is they can create a legacy for the family. They're a little bit flashier. You can get your name out there a little bit more, like the Roland Private Foundation or the Hood Private Foundation, as opposed to the DAF, which may be held at like an institution. The private foundation oftentimes creates a larger legacy for the family. There's operating and non-operating private foundations. Operating private foundations serve their charitable purposes by direct charitable programs and are limited in the amount of grants to public charities. The benefit here, though, is that the contributions to operating foundations have tax benefits similar to grants to public charities. On the other hand, non-operating private foundations primarily make grants to charities Or stated another way, they don't need to meet a threshold amount for direct charitable program expenses. Although they can conduct direct programming, they don't need to meet the magic numbers. If interested in a private operating foundation, I understand we have a bunch of episodes on that. So it's worth definitely referring back to those episodes.
Can you talk a little bit more about contributions of appreciated assets? You mentioned the limitation for contributions of cash, long-term publicly traded appreciated securities. What about other assets like privately held stock or real estate?
Sure. So privately held stock and real estate, they are deductible only up to the lower of the cost basis or fair market value. So you are not getting the benefit of that larger amount. You are having to take the lower of the fair market value at the time of contribution or your cost basis at the time of contribution.
So not a big charitable contribution deduction there for highly appreciated assets of this type.
That's right. Yep.
Stephanie, can you summarize some of the special rules that apply to private foundations that are relevant to the operations?
Sure. So foundation income is subject to a 1.39% investment income tax, as well as a number of other special rules that limit insider transactions, known as the self-dealing rules, ownership and operating business, the excess business holding rules, and limit grants to individuals and organizations that are not public charities, i.e. the taxable expenditure rules. And these rules require generally that at least 5% of the value of the investment assets be contributed to qualifying organizations each year.
Yeah, so that's a lot of traps in those 4 or 5 special areas that are private foundations. In contrasting that to donor-advised funds, they're not subject to the 1.39% tax, but the sponsoring organizations allocate fees and costs. So for a grant-making fund, the overall admin costs can be lower for a donor-advised fund as compared to a private foundation, but it really depends on size. And like you were talking about a minute ago, Stephanie, private foundations can create a legacy for a family, but they carry their own administrative costs. They have to file their own tax return. They have to pay these taxes and pay attention to all this other stuff. But at some size level, that's another distinction, I think. For some of the ultra wealthy, a private foundation is just going to be a lot less expensive to run, even with administrative staff, than trying to operate it through a donor-advised funds.
That's right. And you probably, to some extent, have a little bit more involvement and control at that level.
With a private foundation, you actually appoint your own board members. You're not subject to the ultimate control and policies of the donor-advised fund sponsoring organization. And private foundations can make their grant distributions through a donor-advised funds. And sometimes that's preferable because this is another big distinction. The donor-advised fund is very private and it's not transparent. The identification of the ultimate donor and the ultimate charity aren't necessarily linked. So some donors who value their privacy want to make the contributions through a DAF, where with a private foundation, the names of the donors and the names of all of the grantees are on the annual tax return.
That's right. And those are accessible to anybody who goes on GuideStar, right? That just searching for that form 990, and you can see everything about the private foundation for the most part. It's very transparent.
Yeah, that's a really good point. So any other closing thoughts, Stephanie? I know we've covered a lot of charitable planning ideas and concepts and special rules. Any wrap-up thoughts on how you help a donor when they come to you with philanthropic ideas and goals and maybe a complicated set of assets?
Sure. I think it's getting to understand the client objectives and what they want. Do they want that very, some clients care less about being the face of the foundation or of the gift. They don't mind. They prefer to be anonymous, or they don't care if they are or they are not. Some clients really want their name on that contribution. I oftentimes find with clients, it's a mix. It's a mix of just contributions outright, like they themselves are making the donations to a public charity. Then maybe there's a combination of gifts to DAFs and gifts through a private foundation, but also going forward, what do you want your legacy to be, if anything, and what do you want to instill in your family? And is there a passion project? Is there something that you feel highly impassioned about? And that's where you see clients really creating those private foundations.
So that's a great summary, the passion of the donor, their overall goals, and knowing what tools are out there and what's possible. There's no one size fits all, and a lot of really powerful tools for making very effective charitable gifts. So Stephanie, I can't thank you enough for helping me explain this today. I really appreciate you joining me and slogging through all this technical work.
I've been happy to be here. Thank you for inviting me, Cynthia. Always great to get this out there and so the public can have an easy resource to refer back to when thinking through some of these decision points.
It's terrific. So that's all for this episode. Be sure to check out the show notes for all the links we promised in the episode today. We'll have a lot in there to prior episodes and other resources. I'm Cynthia Rowland, and you've been listening to EO Radio Show, your nonprofit legal resource, brought to you by the Exempt Organizations Group at Farella Braun Martel. If you have suggestions for topics you would like for us to discuss, please email us at eoradioshow@fbm.com. That's eoradioshow@fbm.com. Thank you for joining us. Until next time, make a difference.